It's a brilliant, brilliant event, and you'll come away with lots of new ideas and a better understanding of this incredible exponential world. You get to speak to the smartest people like you trying to figure this out, but also the people on stage. They're the experts. So we get all of that, all in one place, in Singapore. What more can you ask? See you at Token 2049.
Hi, everyone, and welcome to this macro briefing here at Real Vision. I'm Andreas Steno, your host for the next 60 minutes, and I'm pleased to be joined by a friend of mine, but also one of the best macro watchers and risk managers out there, Darius Dale of 42 Macro. Welcome.
Thank you, Andreas, man. That's very kind, especially coming from you. You are a world-class macro analyst yourself, and I just want to say thanks for having me.
It's been a while, Darius, and I truly look forward to this discussion on the macro cycle because we are recording hot on the heels of a rough week in U.S. markets after a great inflation report, but also a Federal Reserve meeting removing the prospects of imminent rate cuts. So, Darius, what are your takeaways after this week of action in dollar markets?
Yeah, it's a great question. So let's start with focusing on the Fed. We've had this long-held belief for going on almost 2 years now that the Fed would need to revise its inflation target higher. We could talk about some of the models that we're using to determine that, to arrive at that conclusion. And as a function of that, we believe the Fed has implemented a de facto upward revision to their inflation target. They haven't told us that. They have not officially communicated that to us. But everything they've done since the early 2022, when we authored that view, has signaled to us that they are allowing. We're essentially frogs in a pot of boiling water, and they are allowing the economy to run hotter for longer. If that's a key takeaway from Fed policy, it's hotter for longer, and this is all part and parcel with our J wants a soft landing theme. And as you know, Andreas, from your side of the pond, you guys tend to be better at that than us U.S. investors. But don't fight the Fed is one of the most important mantras you can live by as an investor. It doesn't always work, but generally speaking, this is a game of probabilities. And so you want to generally play the probabilities when they're in your favor. So that's the Fed. With respect to on the inflation side of things, we are on the precipice of a slowdown in inflation. We're not on the precipice. We are early innings of a more material slowdown in inflation, in our opinion. We don't believe inflation is going to return durably to trend or anywhere near durably to 2%. But of course, as we started with this conversation with, we don't believe the Fed wants that outcome. We do believe that we are in an era of fiscal dominance, and that fiscal dominance is being driven by forth-turning socioeconomic and political factors. And those factors are likely to be persistent for at least another decade. And so we should expect this Fed to continue bending the knee and kowtowing to fiscal dominance over the long term. Doesn't mean asset markets are going to go up in a straight line, but we do know that these dynamics are structurally bullish for risk assets and structurally bearish for defensive assets, risk assets being stocks, credit, commodities, and crypto, defensive assets being treasury bonds, US dollars.
So, Darius, in the context of this Federal Reserve meeting, removing a few cuts from their dot plot this year, and in the context of the early signs of this disinflation process, sort of taking the limelight again in the inflation discussion, how do you view asset allocation and risk management in this kind of environment?
Yeah, how do we do asset allocation, risk management in this kind of environment? So that's a good question and a loaded question, and I think it's a great opportunity for us to sort of explain how we even approach asset allocation and risk management for our clients. Obviously, so I've been on programs like this, for the better part of 3 years here, 42 Macro, or for a little bit over 3 years here, 42 Macro, and generally speaking, we tend to get rave reviews from the audience on our ability to forecast developments in the economy. Where's growth headed? Where's inflation headed? Our policymakers are going to respond to that with changes in policy. And we've generally been on the right side of a lot of those things, not all things, but for the most part, we've gotten a lot of things right over the past few years. But getting things right in terms of predicting where the economy is headed and where policy are headed have no bearing on our asset allocation and risk management process. We use those factors to help clients understand the full distribution of probable economic and policy outcomes so that when there are changes in our risk management process, that they have the confidence to act quickly so that they can take advantage of pending market movements so that they can maximize upside capture in bull markets and minimize downside capture in bear markets. And again, we use a quantitative process to help clients with that, again, layering on the fundamental, the qualitative research, again, just to help them act with confidence.
And Darius, if we look at the asset allocation environment right now, so what are the main takeaways when you look at this from a model perspective? You're talking about risk assets being in a structural bull market, but please fill us in a little bit on your methodology here.
Yeah, absolutely. So that's a great segue here. So we are in a cyclical bull market in the context of a structural bull market. So right now, so what you're looking at here on the screen is our discretionary risk management overlay. This is the primary tool we use to signal to clients what they should be doing now and in what sizes from the context of the various factors that they can be invested in across asset classes. So I'll give you guys a quick breakdown on how this process works. So we are currently in a risk-on reflation market regime. Reflation is one of the two risk-off regimes in our process alongside Goldilocks. And as a function of this risk-on reflation market regime, we have a lot of risk asset type exposures across the equity, credit, and macro markets that are signaling long max positions. And the reason they are doing that is because the proper trade recommendations here in this table, which we update 6 times a week here for our clients at 42 Macro, the proper trade recommendation logic is a function of the interplay between the volatility adjusted momentum signal for that asset and how the asset has historically behaved in the regime, which we've been in this reflation regime for a better part of 2 months now. Preceding that was a 4 to 5 month rally in Goldilocks. And so we've been in a risk on market regime since mid-November. And we actually pivoted at the early part of November, largely as a function of our positioning model, calling for upside risk in equity and bond markets. But we haven't, even since mid-November, we've been in this risk on market regime condition. So let me give you just a couple of indications on how this model works. If a asset, let's sort of pick on the spot here, if an asset is currently bullish from the perspective of our volatility adjusted momentum signal, this Dr. Mo, this discretionary risk management overlay, will recommend a long max position to investors, to our clients for that particular asset. And it will keep that, it will maintain that proper trade recommendation until either the market regime changes or the volatility adjusted momentum signal condition changes for that particular asset. If an asset is neutral from the perspective of our volatility adjusted momentum signal, like commodity producers today, broken down from bullish to neutral today, the model will recommend a long half position for that particular asset. And we'll flag that in real time with the red or green highlighting. If an asset is bearish, if an asset should be bearish in the current regime and is bearish from the perspective of our volatility adjusted momentum signal, then the model will recommend a short max position as it's doing with international fixed income. And then lastly, if an asset is neutral in the current regime and it should be bearish, the model will recommend a short half position in that particular exposure as it is for the US dollar. And so, as I mentioned, again, we are refreshing this table 6 days a week for clients at 42 Macro and flagging any material changes and the proper trade recommendations, which are derived from the interplay, again, between the market regime and the volatility adjusted momentum signal. And one final thing I'll say on our risk management process, the reason we anchor on these quantitative signals to tell clients what to do in their portfolios is because not only do they work, they are some of the most powerful signals that I've seen across the sell side in terms of helping clients, both on the buy side and retail investors, stay on the right side of market risk. So I'll walk you through our VAMs for our volatility adjusted momentum signal backtest quickly, and then I'll summarize and I'll conclude by walking you through our global macro risk matrix backtest. On the volatility adjusted momentum signal, this is the model we use to determine if an asset is bullish, bearish, or neutral from a momentum perspective. Recall that, as you know, Andreas, momentum is the most important force in asset markets. It's not liquidity. It's not plumbing. It's not flows. It's not positioning. It's not growth. It's not inflation. It's not even policy. It's momentum. Momentum is what gets you paid or gets you blown up, especially if you're on the buy side. And so in terms of how we score momentum for our clients, when an asset load, so let's just pick on the stock market here for a second. So in this back test, what we did is we summed daily log price changes for each asset. We have hundreds of assets in the model and the back test. We sum daily log price changes for that asset to determine the cumulative performance of the asset just starting, arbitrarily in January 1998, because I believe we have about 6 or 7 market crashes since then. So it's a robust sample to backtest on. 76% of the cumulative performance in the S&P 500 since January of 1998 has come when our model has had a bullish VAMS condition, has had a bullish condition from the perspective of our volatility adjusted momentum signal. Only 8% of the S&P's cumulative performance has come when it's neutral, and 16% has come when it's been bearish from the perspective of this VAMS signal, which obviously means it's just rallying off crash low. Those statistics are even more exaggerated when you look at the crypto market. So 98% of Bitcoin's cumulative performance since the inception of the asset class has come when our model has had a bullish condition, also just a momentum signal condition for Bitcoin. Only 5% of the cumulative performance has come when it was neutral, and minus 3% of the cumulative performance has come when it's bearish. So the VAMS signal is our most powerful tool for keeping clients on the right side of market risk. This tells you if you should be bullish or bearish on a particular asset through the lens of our discretionary risk management overlay, which again is fueled and powered by our market regime nowcasting process. And so we use our global macro risk matrix to nowcast the market regime. As I mentioned earlier, Goldilocks and reflation are the risk on regimes. Inflation and deflation are the risk off regimes. So just picking on the S&P 500, 83% of the cumulative performance in the stock market since January 1998 has come when our market regime nowcasting process has indicated the asset markets are in a risk on condition. And only 17% of the S&P 500's cumulative performance has come when our market regime nowcasting process has indicated we're in a risk off condition. And as you can see, the dispersion in the Sharpe ratios between risk on and risk off are quite disparate. So it tells you that this is a system that works, and it's a system that works even better for the crypto market. If you segment our market regime nowcasting process, those regimes into risk on and risk off conditions, 109% of the cumulative performance in Bitcoin has come in a risk on condition versus minus 9% has come in a risk off condition. And as you can see, the Sharpe ratios here are quite disparate, which tells you A, this system works, and B, investors should be using this system to guide their portfolio, not necessarily what I think about the Fed or what, the smartest person watching the Fed thinks about the Fed.
You want to unfuck your shit?
Yeah, that's being recorded. Hey, listen, if you want to unfuck your future, then come and join us in the Real Vision community. Incredible platform, amazing content, some of the smartest people in the world, and amazing tools. And guess what? It'll cost you nothing. Come to realvision.com. I'll see you there, and let's help you unfuck your future.
Good stuff, Darius, and it kind of underscores the importance of being structured around the whole process of risk management. In the context of these regimes that you pinpoint, Darius, I'd like your take on the U.S. inflation cycle, especially after the numbers we've received last week from the U.S. economy. We saw some stickiness still in housing inflation, but also signs of disinflation in other categories. And the net result was pretty dovish. So what do you make of the inflation cycle here, Darius, and especially the housing inflation cycle, which is probably the most important from now?
Yeah, it's a great question, Andreas. And so getting back into the qualitative side of our research process, which we use to help investors act with confidence whenever one of those risk management signals changes, right? If you see if the proper trade recommendation for the stock market goes from long max position to long half position to short half position to short max position, then you need to understand why that's happening and what could potentially perpetuate that over a medium-term time horizon. And so we do a tremendous amount of research for our clients and helping them understand the full distribution of probable economic and market outcomes. So with respect to inflation specifically, that cycle, let's break it apart into our cyclical views on inflation as well as our structural views on inflation. Our cyclical view on inflation is that inflation is likely to continue decelerating over the medium term. It has a reasonably high chance of surprising elevated consensus expectations over the medium term to the downside, which obviously is a very supportive dynamic for asset markets. If it does not surprise consensus expectations to the downside, it's probably because the downward momentum in the time series are causing consensus expectations to decline. So either way, you're talking about a potentially positive scenario for inflation over the medium term. And one of those things that's driving that here on slide 47 is the disinflation, the accelerated disinflation that we're observing in shelter CPI and in housing PC inflation. So in this chart here, we show the FIFA home price index, my apologies, the FIFA home price index on a 3-month annualized, 6-month annualized, and year-over-year rate of change basis. We show the same dynamic, show the same figures for the Case-Shiller home price index, and then we lag that by 24 months as an indication of, okay, where we are in the inflation cycle, because that times up with the accelerations that we observed in this particular cycle. It's not always 24 months, the lead time. Sometimes it's closer to 12. Sometimes the median is about 18 months when you see inflections in reported home price inflation to observed and reported shelter inflation. But this cycle is 24 months. So with that in mind, we are currently on the precipice of a significant deceleration in observed home price inflation. And right now, you're kind of starting to see that ever so slightly in the shelter CPI numbers. This 4.8 3-month annualized rate of change on shelter CPI is the lowest number we've seen since 2020. And if you look at the housing PC inflation, PC deflator inflation statistic, that number is a little bit more lagged. We only have April data, but the April data came out at 5.1% 3-month annualized, and that's been the lowest number we've seen since December of 2021. So this movement that we're seeing here in these time series is suggestive that we could, in fact, be on the precipice of this accelerated disinflation process in shelter inflation. When we think about inflation from other categories as well, namely, median CPI and trim mean CPI, we're seeing a lot of positivity in those time series as well. So, one of the things that we like to look at, again, as I mentioned, inflation across all categories. What are the main categories of headline CPI? What are the main categories of core CPI? But I think in terms of identifying, okay, what's actually happening in the economy that can give you some more conviction in the near-term direction on inflation, you got to understand what's happening across the broad basket, which the median CPI and trim mean inflation statistics do. And we're seeing significant improvement in these categories. And so if you look at median CPI, we decelerated to 3.8% in May. That's the lowest number we've seen since December, but it slowed by 70 basis points, which is the slowest rate of change we've seen since July of last year. And trim mean CPI, we're actually almost getting close back to trend at 2.9% on a 3-month annualized basis. That's the lowest, again, number we've seen since December. And the 80 basis point deceleration is the slowest deceleration we've seen since May of 2023. So we are having some pretty positive inflation outcomes, and they are supportive of our previously held views that inflation is likely to decelerate over the medium term and surprise to the downside. And that dynamic in isolation is positive for asset markets. Now, as you can see, the headline of the takeaway and the reason this chart is in the left tail risk section of our monthly macro sky report, which we put out every month for our clients. The reason it's in the left tail risk section and the reason the headline reads what it is, which is underlying inflation is unlikely to return durably to trend absent a recession, is because we know, based on our analysis of the business cycle, some of the best analysis that I've seen, quite frankly, we know that inflation is the most lagging indicator of the business cycle. And historically speaking, you tend not to see inflation break down below trend until well into a recession. We're talking 12 to 24 months into a recession. And so because Jay Powell wants a soft landing and is doing everything in his power to implement and engineer that outcome, it's unlikely we get back to and through trend on inflation, which would allow it to get around 2 to 2.5%. So we believe inflation is going to bottom and reaccelerate from a level that is very much inconsistent with the Fed's 2% stated 2% target. But again, as we started off at the beginning of the show, we don't believe 2% is the real number. We think they're operating from a 2.5 to 3% number. They just haven't communicated that to us yet.
Darius, we've seen how both economists within the Federal Reserve System, but also economists on the sell side, have discussed this shelter inflation and whether it makes sense to take decisions based on this shelter component, since it lacks the actual cycle in home prices. So if anything, the Federal Reserve has probably managed to bring the inflation back to target for those that are homeless. But setting this shelter inflation aside, does that make sense in decision making? Where are you in that debate?
Yeah, well, look, this is the Federal Reserve. They got burned by their forecast in 2021 and in early 2021, throughout 2021, and has since pivoted to a data dependency regime. And that data dependency regime is probably better than what they used to do, which was be horribly wrong with respect to the projections for growth, inflation, and ultimately the policy rate itself. So the Federal Reserve is actually quite bad at forecasting where the policy rate is. That's a untold secret across the global Wall Street. But anyway, so in our view, this is a Fed reaction function that is data dependent, but it's a asymmetrically dovish reaction function, which is in my opinion the more important takeaway for asset markets. With respect to shelter inflation, we have a tremendous amount of conviction that shelter inflation is likely to slow at a more material pace over the medium term for two reasons. One, as we highlighted, with the lagged impact of observed home price deceleration that we saw in those time series. But secondarily, when we go back, we did a big deep dive study on business cycles that looked at time series, every major time series across, growth, inflation policy in the U.S. economy, with data going all the way back to the 40s, so that we can get a sense of how each indicator has historically performed in each of these post-war business cycles. And one of the key takeaways with respect to inflation is that, one, inflation is the most lagging indicator of the business cycle in terms of how the business cycle functions. First, particularly when you're late in the business cycle, what happens is policy rate tightens, then liquidity starts to drain. Then you start to see a breakdown in corporate profits, followed by a breakdown in growth, followed by a breakdown in asset markets. Then you see the breakdown in employment. Then you see the breakdown in the credit cycle. Finally, you see the breakdown in the inflation cycle, usually sometime between 12 to 24 months after a recession starts. So that's takeaway number one. Takeaway number two, specifically as it relates to inflation itself, is shelter inflation is one of the most lagging elements of the inflation cycle within the inflation cycle. But the takeaway number three from that deep dive empirical study, which our clients are, very much benefiting from here at 42 Macro, the takeaway number three, which I think is a very important takeaway for the medium-term outlook for asset markets, is shelter inflation typically decelerates late in the business cycle, only to reaccelerate heading into recession. So we could kind of, if you think about this, if you're riding a roller coaster, we're kind of at the precipice of this kind of, loop down. If we throw the chart back up on the screen, we're on this precipice of this loop down in shelter inflation before it reaccelerates, heading into a recession, which is, in my opinion, probably one of those dynamics that is contributory to the recession as it relates, in terms of squeezing consumer incomes late in the business cycle after the employment cycle is already rolled over. But again, I don't think we're anywhere close to a recession, but we could be at this point in the time series where shelter inflation is decelerating and creating some significantly positive outcomes from the perspective of asset markets through the lens of, pulling forward rate cuts and allowing the Fed to continue sounding and talking and implementing this asymmetrically dovish policy, which itself is a upside driver of global liquidity.
So Darius, assuming that you're right, that we'll get a disinflation process, but we'll not get back to this trend inflation, say around 2% or just below 2%. I'll ask you this question. Does it really matter whether we have 2 or 3% inflation from a risk management and an investment perspective?
Ooh, that's a great question. So we know what this we know. I've read a series of white papers on the origins of the 2% inflation target, and by and large, it's pretty random. Now, there was a multi-year process of the Federal Reserve arriving at 2% inflation starting in the early 90s, culminating with Bernanke in 2012, when they initially outlined it as their official inflation target. But the origin of the 2% level itself, in fact, is actually quite quite random. It comes back from the Reserve Bank of New Zealand. They just stuck their finger in there and said this has been the best level. But we know empirically from studying things like the Case-Shiller time series that my former professor at Yale publishes, we know empirically that this kind of sweet spot for asset markets is 2% inflation, 2 to 3% growth on a real basis. And so generally speaking, advanced economies like those types of dynamics. In our opinion, answering the question specifically, we believe that the underlying trend of inflation has jump conditioned higher. Maybe not jump conditioned, that's too strong of a statement, but it has transposed itself higher as a function of the evolution of some of the critical drivers of inflation in the economy, right? I'll start this comment by saying, having read dozens and dozens of white papers on the inflation process, both in the U.S. and global economy across the borders, no one really knows how inflation works. We know how to study it empirically, and we know what leads it. We know what correlates with it. We know what lags it. But if you, from a first principles perspective, there doesn't seem to be any general consensus across the economist community on how the inflation process works. We just know how, what leads it and what lags it, stating back to the business cycle study that I highlight, our business cycle study. So with that in mind, this chart here is our secular inflation model, this table here. It contains a series of time series that we know to be either highly correlated with swings in the inflation cycle or highly co-integrated with the underlying trend of core PC inflation. And what the model does, it interpolates the normalized change of these key indicators back upon the underlying trend of core PC inflation, which if you go back and you look at the decade, the horizontal level at which core PC inflation cycled around was 1.6 on a trend basis. If you look at our sector inflation model, on a mean basis, the model is saying the underlying trend of core PC inflation has transposed itself 100 basis points higher to 2.6%. If you look at it on a weighted basis, in terms of the factors that have the highest weight in the model based on their relationship with the underlying trend of core PC inflation, then the model is saying we have 3% trend core PCE over this next decade. And so whether it's 2.6% or 3%, I don't think is particularly relevant. What is relevant is the fact that both of those numbers are above the Fed's stated 2% inflation target. And so what this tells you is that the factors in the economy that are causing inflation to be higher in this business cycle than they have historically, things like high commodity prices, things like deglobalization, things like the explosion in fiscal policy in terms of the easing of fiscal policy, productivity being down, wages being up, household, the amount of cash and liquidity on household and corporate balance sheets being extremely high relative to trend. All those types of dynamics are contributing to a scenario where the underlying trend of core PC inflation, according to our model, which we published this at the start of 2022 and have refreshed it every month for clients since, the underlying trend, if the underlying trend is in that level, then it ultimately means that this is a Federal Reserve that has to lean on the economy and lean on the asset markets with perpetually tight policy to get inflation back to 2%, which, in our opinion, in a forthturning economic regime where the size of the federal government on a fiscal basis has to explode and has to get much larger, both on a absolute basis and also relative to expectations, because that is the underlying dynamic, political and social economic dynamic in the economy. We believe this is a Fed that has effectively kowtowed to fiscal dominance. And instead of leaning on the economy and leaning on asset markets to perpetuate 2% inflation, they're effectively throwing their hands in the air, throwing their hands behind their back and saying, we don't really need to. We'll get to 2 over time. We'll get to 2 over time. We'll get to 2 over time. And guess what, Andreas? When we look back at this 5 to 10 years from now, we'll realize that we never got to 2. And that's, my friends, how you implement a de facto positive revision to your inflation target without spooking asset markets.
Yeah. So, Darius, I agree with that takeaway. And you'll know that I also love reading tea leaves. Given this discussion on the structural inflation level and how the Federal Reserve will inflation to run harder than their de facto target at 2%, what are the signs you're seeing right now that they're actually accepting inflation above target?
Yeah, well, I mean, the number one sign is that they are guiding the rate cuts with inflation comfortably above target. So if you go back and you kind of look at what's priced into the forward rate curve right now, so we got the dot plot yesterday. So this was recorded on Thursday, June 13th. We got the dot plot yesterday, and after the dot plot, even with the hawkish revision to 2024 and 2025, there's still people see that as this is a hawkish revision to the dot plot. But what's actually happening is the Fed is still guiding to rate cuts, with core inflation being comfortably above their target and other measures of inflation still being comfortably above their target. And so right now, and as a function of that, money markets are pricing that in and sending that easing, that dovish signal into broader asset markets, which is perpetuating and extending the duration of the business cycle and helping perpetuate and engineer that soft landing outcome. So if you look at so in this chart, we show the dot plot for 24, 25, 26, and in the long run dot plot, the red line shows the corresponding year-end Fed funds rate. And then the black line in the chart just shows where that corresponding year-end Fed funds rate is minus the previous year's Fed funds rate or the current year for 2024. And right now, after yesterday's dovish, everything the Fed says, in my perspective, has been dovish really for the past kind of 6-7 months, really going back since November. As a function of this, we have 2 rate cuts priced into 2024. We have essentially 4 rate cuts priced into Fed fund futures markets in 2025, none in 2026, and then another 2 to the ultimate market's expectation of the terminal neutral rate of 3.5-ish%. And so all of this easing, two cuts in 24, 4 cuts in 25, and another 2 cuts, let's call it in 2027, all that easing is currently contributing to easy financial conditions, and easy financial conditions in an economy as hyper-financialized as the U.S. economy is contributing to the duration and extending the duration of the business cycle. And one final thing I'll make on that is that the hyper-financialization of the economy is something that I don't think is appreciated and understood enough with respect to the shorter term, cyclical swings in growth and inflation. In this chart, we show private non-financial sector debt to GDP, the private non-financial sector debt to GDP ratio, and in the black line, we show the bank share of private non-financial sector debt. And at 33%, the U.S. is by itself relative to peer economies in terms of only 33% of private non-financial sector debt being on bank balance sheet. That means the other 70-ish% is off bank balance sheet and being generated by the capital markets. And so fluctuations in things like credit spreads, equity valuations, interest rates, the level of interest rates, the direction of travel of interest rates, those things have a more significant influence on growth and inflation in the U.S. economy than they do in other economies. And so as long as this Fed continues to help money markets price in a significant easing cycle over the medium to long term, that, in our opinion, is certainly contributing to this persistent, easy financial conditions that have obviously contributed to all-time highs in stocks, almost near all-time highs in a lot of cryptocurrencies, and obviously a pretty voracious bull market in gold and many commodities.
Darius, earlier you labeled the current macro regime reflationary. And in the context of these easy financial conditions, etc., how do you actually define reflationary here? Is it a signal that the economy is accelerating, or how do you define this reflation regime in the context of this discussion?
Yeah, absolutely. So in terms of we've back tested everything that ticks in terms of how to think about this from a factor dispersion perspective. The system we use to identify what the market regime is our global macro risk matrix. And so, taking a step back, just to answer your question before I even get into this, reflation is a risk-on regime with an inflationary bias. And so that's the regime we're currently in. My suspicion is that if we are right on our fundamental views that inflation is likely headed lower, it's likely to surprise consensus expectations to the downside, and or the inflation expectations themselves are likely to get dragged lower by the data over the medium term, that, in our opinion, could perpetuate a phase transition back to Goldilocks, which is a risk-on regime with a disinflationary bias. That's where we were from November all the way through to early April. And so in terms of the system that we use to now cast the market regime, which, again, this is going back to the beginning of the discussion, the global macro risk matrix backtest that we highlighted, it's born out of this system. What we're doing here is we're scoring 42 of the most important markets in the world through the lens of that volatility adjusted momentum signal that we backtested, we discussed earlier here on the slide. And then each of those signals corresponds to a particular regime from a condition standpoint. So, for example, the bullish vamp signal today for the S&P 500 is currently generating 1 point for both Goldilocks and reflation in this system, because historically the S&P 500 has been bullish in Goldilocks and reflation. It doesn't know if it's Goldilocks or reflation, but it's getting a point. Both of those regimes are getting a point. We're doing that same process across each of these 42 markets on a daily basis. So, for example, the bearish VAMS condition in the 10-year break-even rate today is contributing a 1.2 deflation, because historically the 10-year break-even has been bearish in deflation. And so when we tally this all up, we arrive at the conclusion that 27 of these 42 markets are currently suggesting that reflation is the regime. It's the highest sum and the highest share of the total, which is why we say we are in a reflation regime. Again, the reflation became the dominant regime in this market regime nowcasting process back in early April. Prior to that, it was Goldilocks. Goldilocks was the dominant regime from kind of mid-November all the way through to early April. And going back to our discretionary risk management overlay, as long as we are in a risk-on market regime, the proper trade recommendations for all risk assets are going to be either long max position if the asset is bullish from the perspective of our volatile adjusted momentum signal, or a long half position if the asset is neutral. And if the asset somehow is bearish, but it should be bullish, then the model will the proper trade recommendation will be don't do anything, don't touch it, don't buy things that are bearish, that bearish price and vol momentum in a bullish regime, because something that's telling you that the market knows something about this particular exposure, your assets, you're better going to be more rewarded elsewhere.
I love the front run your own model now, Darius.
That's what I do. That's what I do all day for our clients.
Yeah,
that's exactly what I do.
Yeah. So, Darius, this structured approach to macro regimes in the context of this inflation volatility that we've seen over the past couple of years, what led you to try and structure it this way? Was it this inflation volatility that we saw from 2020 and onwards, or what was your sort of clue to start looking at regimes in this way?
Yeah, it's the same way that I think we all, as investors, as athletes, as anybody who's in a high performing competitive environment, improve their process through mistakes and through learning from those mistakes. And so the worst period of performance. So I've been doing this since 2009, and then I've had the great pleasure of flying across the world many times over, meeting with some of the most sophisticated, and CIOs and portfolio managers across the global buy side for the past 16 years, and really just grateful for our ability to collaborate, my ability to help them improve their processes, and obviously them helping us improve our process. And one of those things one of those periods in time where I was doing a lot more reflection than evolution was going back to Q4 of 2022. So if you recall, in December of 2021, we turned very bearish after having been bullish, and we got the market call right on terms of being bearish on risk assets throughout 2022. We ultimately got to the bearish bond call, but it took us a little bit longer than that. I'm sad to say. But going back to Q4 of 2022, we got royally squeezed. It felt like everything I did, every single call I made back in that moment in time was wrong. I'd say the market would go up, it'd go down. If I said the market was going to turn left, it turned right. And that went on for about 3 months. And in that moment, I had an aha moment as a function of that poor period of performance, which was the worst period of performance that I've ever had in my career. I've generally done a good job of keeping our clients on the right side of market risk, largely as a function of the process that we killed in that moment of time, which is our discretionary process. And this takes me to another element of our process, which is the overcoming behavioral heuristics. I was succumbing to my own behavioral heuristics at the time that said, okay, I'm smarter than the market. I'm ignoring our own market regime nowcasting process and ignoring our own signals to tell clients to continue to stay short this market, because we continue to thought we had some negative views on liquidity that ultimately proved to be inaccurate. And that led me to conclude that Darius Dell, this human being, should not be responsible for the trillions of dollars of capital that our clients are putting to work on a daily basis. And so what we did at that moment in time, going into early 2023, was to remove Darius Dell's views on the economy and policy and where those are headed from our risk management signaling process. And boy, oh boy, has it worked wonders for us. And the behavioral heuristic that we had to overcome, that I personally had to overcome in that moment specifically, was the illusion of validity. And so for those who are not familiar, one of the things that is very core to what we do here at 42 Macro is we stand on the shoulders of giants in terms of applying proven quantitative techniques and proven behavioral economics techniques to our research. You'll see a lot of the regime segmentation, Bayesian inference, using volatility as a leading indicator of price, things we learned from guys like Ray Dalio, Danny Kahn, and Amos Tversky, Benoit Mandelbrot. These are all, sort of core linchpins of our process. And another core linchpin of our process that we've, in terms of the evolution of our process that we created back in early 2023, was to rid ourselves of the illusion of validity. And the illusion of validity, for those who don't know, is one of the common behavioral heuristics that prevent investors from achieving their strategic investment objectives. And specifically, the illusion of validity is a cognitive bias that describes our tendency to be overconfident in the accuracy of our judgments, specifically in our interpretations and predictions regarding a particular data set. So go back to Q4 of 2022, we were highly convicted. I was personally highly convicted in the bear case because we thought liquidity would continue to drain, because we thought, we were not going to achieve the outcomes on inflation that the market was starting to anticipate. Both of those fundamental views turned out to be wrong, by the way. And so the solution that we infused into our process, that we created in the context of our systematic daily process for our clients, is that we pivoted from more of a prediction heavy process to a process that's heavy on observation, a process that's more institutional. Institutions rely on observation and less on their own predictions to manage risk. And when we do make predictions, they're generated by models and that apply proven quantitative techniques. But more importantly, when we do make predictions, they are separate and apart from our risk management signals. and we only use our predictions of what's going to happen in the economy to inform us and inform our clients on how those signals may evolve over certain time horizons. We're not saying, hey, start shorting the S&P, even though it still says long max position in the discretionary risk management overlay, because I'm fundamentally bearish. That is a no-no. That is exactly what we're not doing for our clients here. We're saying, hey, the fundamental outlook may be evolving in a way. We're not saying that, but we could potentially be saying, hey, the fundamental outlook's evolving in a way that might make that proper trade a signal go from long max position to long short or to short max position over the course of this particular time horizon. So be aware of that. If you are a slower moving investor and you have a much lower turnover in your process, that you need to kind of proactively prepare for that ahead of time. So that's how we use predictions in our process. And it's like I said, Andreas, it's really worked wonders. I'm very humbled by the success that our clients are having in their portfolios. One, as a function of following our discretionary risk management overlay here on slide 21, or as a function of following our KISS portfolio construction process. So the discretionary risk management overlay that we've been talking about for the past, kind of 45 minutes or so, that is how we communicate to sophisticated retail investors on up the sophistication curve with respect to what factors they should be doing, how they should be approaching the various factor risk in their portfolio, long this, short that, how much long this, how much short that. For investors that are sort of on the lower end, not lower, that lower is probably a bad word, pejorative word, but who are might maybe less sophisticated or earlier in their investment journey, we built our systematic KISS portfolio construction process to help them manage risk, which is a much more simple process. In fact, I think it's one of the more simple processes that I've seen out there in terms of helping retail investors stay on the right side of market risk. And what this process does is it's a 60-30-10 trend following strategy that has 60% equities, 30% fixed income, and 10% Bitcoin. And then we use our market regime nowcasting process that we've been talking about the whole time. And we use our volatile adjusted momentum signal to infuse vol targeting and dynamic position sizing into that 60-30-10 strategy. So it's not always long 60-30-10. Sometimes it's 50% equities or 5% Bitcoin or 25% fixed income. But those changes that KISS are making at any given time are systematic. Darius Dell's views on inflation, Darius Dell's views on policy, Darius Dell's views on growth have nothing to do with this process. And quite frankly, even though I think I'm really good at, and our clients will tell you that I'm really good at forecasting those things, the reason this works is because our volatile adjusted momentum signal and our market regime nowcasting process are actually more powerful than my brain at predicting what's going to happen in the economy.
Thanks for sharing that story, Darius. I love your honesty, and I love the work that you do. Tremendous stuff, and thanks for sharing that. Darius, I'd like to get your take on how to deal with exogenous shocks, given your structure here. Was it last weekend we had the EU parliamentary election in Europe, and all of a sudden the risk of a very sharp right turn in French politics entered the limelight in European markets. We've seen bad returns in French bonds and French equity markets. And I'm not expecting us to go into the weeds of discussing French politics here, but how do you deal with an event like that, given your very structured approach to risk management? Is it something that you'll allow data to decide for you anyway?
Yeah, it's a great question. I love that question because to me, I think the if you correct me if I'm wrong, Andreas, underlying that question is a different question, which is, are you comfortable? What type of error are you comfortable with? And the types of errors that we are comfortable with, the types of errors that we're comfortable with having our clients experience are more of the quantitative head fake variety as opposed to the fundamental I'm wrong variety. Because the fundamental I'm wrong variety takes longer to recover from. It takes you longer to realize you're wrong fundamentally. And as a function of taking longer to realize you're wrong fundamentally, you wind up having a bigger drawdown if you are wrong in those assets, either on the short side or the long side, because you've been wrong fundamentally. Conversely, if you're using a quantitative risk management process like ours, vis-a-vis our market regime nowcast or volatile adjusted momentum signal or that simple KISS portfolio construction process, KISS just stands for keep it simple and systematic. If you're using a quantitative approach, then you're going to have head fakes, but they're going to be short-lived and ultimately are going to resolve themselves much quicker in a way that can help you get back to making money and saving money in asset markets. So answering the specific question, Andreas, how do we deal with things like exogenous shocks? To me, it's more about, okay, is this exogenous shock happening at an adverse time in the positioning and liquidity cycles? Or is it happening in a really positive time in the positioning and liquidity cycles? And for specifically with respect to the positioning cycle, adverse shocks on, so now I'm rotating back into the U.S. Because I don't have too many insightful comments on what happened with the European parliamentary elections. I'll leave that to you, my friend. But rotating back to the U.S., let's say we had a similar adverse shock from a political cycle standpoint here in the U.S., which we very well could, right? it's a fourth turning election this November. Who knows? All hell could break loose again. We had all hell break loose last time, if you recall, in our U.S. Presidential and congressional election cycle. So, we very much could see similar risks here develop in the U.S. And the reason that's an issue from a fundamental perspective in terms of thinking about how the market regime may evolve over the medium term is because we are not in a good spot from the perspective of the positioning cycle. And we're not in a bad spot from the perspective of the liquidity cycle, but we're not in a great spot either anymore. So let's start with the positioning cycle. So on this chart here, we show our positioning model. What we're looking at is a series of indicators that we're scoring on percentile terms relative to the historical time series. And they were identifying critical thresholds that those indicators have reached at major bull market peaks and major bull market troughs. And when you isolate the indicators that are more correlated to the medium to long-term performance of the market, so 3 months to 1 year plus performance of the market, 6 of those 7 indicators that correspond directly to the equity market are actually flashing red, i.e. they've breached the median value they've historically observed at the peak of the S&P 500 bull markets. So, for example, the AII stock allocation survey is in the 86th percentile. That's already passed its bull market signaling threshold. The bond allocation survey is down in the 27th percentile reading. That's below where it typically is at major bull market peaks. Cash is in the 16th percentile. That's below where it typically is in a major bull market peak. If you look at S&P 500 realized volatility, which we use as a proxy for systematic fund participation in the market, that's reached it's all the way down in the 28th percentile, which breaches its bull market peak threshold. Implied correlations in the market in the 0th percentile, which we use to interpolate what market neutral players are in terms of their gross exposure to markets. They're maxed out probably at this current juncture, which obviously indicates that they were past their bull market peak signaling threshold. And then lastly, with respect to valuation, if you look at the S&P 500 price to next 12-month earnings multiple, it's in the 85th percentile, which is beyond the median level we've observed at these major bull market peaks. So as I mentioned, 6 of the 7 indicators, with the exception of our aggregated U.S. equities non-commercial net length divided by total open interest metric, that metric has yet to breach that. But there's a lot of metrics that are flashing red right now. And so adverse shocks, exogenous shocks, things like political cycle dynamics that are hard to forecast statistically, when those types of things happen and you're in a good spot in the positioning cycle, the market can correct and recover and go on about its merry way. However, when you're in a bad spot in the positioning cycle, those types of adverse shocks, can create a correction deep enough to cause risk management systems across the global buy side to change too. And our models will pick that up in real time and have our clients, divest and rotate out of, more offensive factors into more defensive assets so that they can minimize downside capture in a potential bear market. That's the whole name of the game in terms of risk management. So that's one side of the equation on the positioning cycle side. The other side of the equation is, okay, where are we in the broader liquidity cycle? So you need to get both of those cycles right to understand how exogenous shocks are going to influence asset market behavior. So in this cycle, in this table here, this is one of my favorite tables that we use to communicate to our clients because it helps them understand something that I think is a very misunderstood topic across, sort of the global investing community that we're all participating in and we're, grateful to participate in, which is this, squishy concept of liquidity, which itself, the word liquidity implies that it's pretty squishy, right? And so what we did in this table here is we identified various liquidity cycles since going back to March of 2009 so that we can apply some statistical analysis to this to help the clients understand what is a liquidity cycle, what type of performance should you expect from asset markets in the liquidity cycle, what type of drawdown should you expect from asset markets, liquidity cycle inflects into a negative cycle, or if you're in a liquidity cycle upturn. And so going back to this concept of where are we in the liquidity cycle, how might exogenous the shocks impact that, let's just kind of isolate this. Let's look at where we are. So we are in a liquidity cycle upturn that began in October 2022. This liquidity cycle upturn has lasted for 19 months for a duration of 1.6 years. Both of those numbers are shy of the median liquidity cycle upturn value. Historically, the liquidity cycle upturns have lasted about just shy of 2 years. But So we have not achieved the kind of median level of time, but we have already gone past the median level of performance. If you look at the S&P 500, for example, is up 40% since October 2022, and we certainly missed the first 3 months of that as a function of that, that process pivot we ultimately had to make in January of 2023 when we got bullish. So we're up 40% in S&P terms throughout this liquidity cycle upturn. That has already vested its median value of plus 37% in liquidity cycle upturns. We're right at the median performance for the NASDAQ at plus 72%, even though we've had a much shorter liquidity cycle upturn in time terms. But what concerns me about a potential exogenous shock, or really anything bad, Andreas, happening in growth, inflation, and policy terms, we could be wrong about inflation. We could be wrong about growth remaining resilient, which we haven't even talked about today. If we're wrong about that stuff, then we are concerned. What's concerning me is the fact that we have not achieved the median max drawdown that we've typically seen in assets in the liquidity cycle upturn. So the max drawdown we've seen in this liquidity cycle upturn for the S&P is minus 10%. It's minus 11% for the NASDAQ. It's minus 27% for Bitcoin, and it's minus 34% for Ethereum. If you look at the median max drawdown during liquidity cycle upturns for those assets, it's minus 14%, minus 16%, minus 61%, and minus 51%. So the conclusion of this analysis is just the conclusion of that final statement that we're making here is that, yes, we're in a liquidity cycle upturn. It has not gone as far as it typically goes in time terms. It's already achieved the type of performance we've seen in performance terms. But on the left tail side of the equation, we could still have a pretty significant correction in asset markets, despite still being in the liquidity cycle upturn, because we're nowhere near achieving the median max drawdowns that you've typically observed in liquidity cycle upturn. So I just want to make sure investors are aware of this, because what it ultimately means, going back to this kind of squishy concept of liquidity that we see everybody tweeting about, from mom and pop retail investors to even sophisticated buy side portfolio managers. What it ultimately tells you is that you still need to respect market risk. You still need to respect momentum in asset markets, because you can suffer some pretty significant drawdowns, particularly in the crypto market, even if liquidity is trending higher, because there are other factors at play here. Liquidity is not the only thing that makes markets go up and down. Growth is not the only thing. Inflation is not the only thing. Positioning is not the only thing. Policy is not the only thing. All those things matter together, and it's our job, you, myself, Andreas, and me, myself, for our clients, it's our job to piece the puzzle together in a way that helps our clients make money.
Yeah, you're absolutely spot on, Darius, and I just love how we get into the weeds of structuring the risk management approach in this discussion. And to your question on why we haven't discussed the growth cycle yet, I guess the answer is, who cares? We'll have to look at the data, right? Instead, Darius, one final question, and I know I'm asking on behalf of a few viewers here. How do you hedge against a structured approach being wrong? This is a question I get a lot from some of my wealthy clients. They're not necessarily overly concerned with getting the absolute best return, but they're very scared of deep drawdowns. So what is the ultimate hedge against being wrong in a structured approach?
Oh, I love that question, because to me, that's the number one main in the game. And it goes back to what we talked about in terms of what kind of error are you comfortable delivering to your clients? Because you are going to deliver error to your clients, whether you are a buy-side investor or a sell-side investor, collaborating with buy-side investors. And so the answer to our approach is, the answer to the question, answer to our approach is, we are comfortable with quantitative head fakes. We're comfortable being the second person in the trade, not the first person in the trade, because we understand that being the first person in the trade means you could be very wrong if the trade never starts. Right. That's the problem with being the first person in the trade, is that you can have a fundamental view that's based on your expectations of what's likely to transpire in growth, inflation, policy, liquidity terms, et cetera. But ultimately, if those things don't come to fruition, much like my own personal experience during the worst period of performance of my career in Q4 of 2022, if those predictions don't come to fruition, then you have bigger drawdowns than you would have otherwise had you just adhered on a quantitative approach. So let me take you to our KISS portfolio construction process back test to answer that specific question, because again, I agree with you that the folks, the more money you tend to make, the more you're concerned about not losing it. That tends to be the case, whether you're a retail investor or even a professional investor, in terms of pension fund type allocators. So this KISS portfolio construction process back test is an out of sample back test that starts in January of 2018. The blue line in this chart is KISS. The red line in this chart is a 60-40 portfolio, which we benchmark KISS against. And then the light blue line in the chart corresponds to if an investor were to just be long 60, 30, 10, SPY, AG, Bitcoin, which is the three exposures that we have feature in the KISS portfolio construction process. So if you are long KISS, the average annual return, so KISS is average annual return in this out-of-sample back test, and it's been live for our clients since January of 2023. The out-of-sample, the average annual return in this back test on an out-of-sample basis is plus 14%, which is about 500 basis points higher than the average annual return for 60-40, and it's right around the same average annual return that you would get if you were just long perpetually 60, 30, 10, SPY, AG, and Bitcoin. But answering your question on the risk side, Andreas, the reason we love our processes on the quantitative signaling side is because they're not perfect. They don't prevent you from losing money, but they prevent you from losing way less money, or they prevent you from losing more money than you otherwise would without them. And they prevent you from losing as much money as you would if your process was focused on a position-driven risk management as opposed to observation-driven risk management, which is what we do here at 42 Macro. So, for example, if you look at the max drawdown throughout the life of this out-of-sample backtest, KISS, our systematic KISS portfolio construction process, has a max drawdown of 12%. It's the only double-digit drawdown since January of 2018 in this process. Compare that to 60-40, which has a max drawdown of 22%, and it's crashed twice in the life of this out-of-sample backtest. And then if you were going to run 60, 30, 10 raw without our top-down and bottom-up risk management overlays, which feature our market regime nowcasting process and our volatility adjusted momentum signal, then you're talking about a max drawdown that's more than double of minus 12%. It's minus 26%. And oh, by the way, you've crashed 3 times since January 2018 in your portfolio if you were going to run that without the quantitative tools that we've infused into the process. So the key takeaway here, and the reason we kind of wanted to end on this, is to remind investors that you're not going to completely eliminate the left tail of returns from your portfolio. It's not possible. Only Bernie Madoff did that, and last time we saw from him, he was hanging from a jail cell. So unless you want to wind up hanging from a jail cell, you're probably going to have to suffer some drawdown to make money in asset markets. You have to risk capital to get the reward of the return. However, what we found through implementing these processes for our clients for the past 3 years, and obviously through careful institutional grade backtests, is that we find that quantitative processes cause you to lose less money than fundamentally oriented processes, which is why firms that we partner with, all the big market neutral hedge fund platforms in the world, they're all of our clients. You think about the major asset management firms, even some of the macro firms over the past few years have migrated less and less from using predictions to generate their portfolio construction to more observation-based processes and procedures like the ones we feature in our process here at 42 Macro, i.e. nowcasting the market regime, using the market regime and the volatility adjusted momentum signal to help investors understand what the proper trade is across asset factors. And then if that's too sophisticated for you, then just follow the simple 60-30-10 KISS portfolio construction process and let that lead you to some positive investing outcome.
Darius, Dale, such a pleasure to host you here at Real Vision again. I always love our discussions, and I look very much forward to bringing you back here on the platform. I know that you are a true fan favorite out there. Thanks for joining us.
Andreas, man, thank you for having me, and I appreciate this long form, but I do appreciate the opportunity to kind of open the kimono a little bit here for the Real Vision audience, because I'm really grateful to be partnered with you guys. I think we're with Rao and the team over there. Ryan, Nico, all you guys have really built something that's excellent. And I'm just grateful for the opportunity to show people that we don't all have to invest the same way. Like Michael Jordan didn't play basketball like Steph Curry, but they both won a lot of championships. Pat Mahomes doesn't play football like Tom Brady, but they both won a lot of championships, and one is still winning championships. And what we're finding is that our clients here at 42 Macro have consistently won championships as a function of our differentiated observation-based, quantitative-based research and risk management frameworks. And we're really proud of that.
Yeah. And as a true golfer, I'll finish with a quote that I use a lot. There are no pictures on the scorecard. So if you make returns, then you don't necessarily need to tell people how you did it. Once again, Darius, a pleasure hosting you here. Thanks for sharing all of this information with our community at Real Vision. I'm Andreas Steno. Thank you for watching this deep dive into the macro risk management framework of 42 Macro. We'll be back again soon on platform.
It's a brilliant, brilliant event, and you'll come away with lots of new ideas and a better understanding of this incredible exponential world. You get to speak to the smartest people like you trying to figure this out, but also the people on stage. They're the experts. So we get all of that, all in one place, in Singapore. What more can you ask? See you at TOKEN2049.
We hope you enjoyed the video. At Real Vision, we help you understand the complex world of finance, business, and the global economy with in-depth analysis from real experts. Join the revolution at realvision.com.